Good morning and welcome to our webinar. This is the first of two webinars, with the second scheduled for Wednesday the 13th of October. Today we'll be going over the ways to spot the signs of distress in a business and the ways to address them. I'd like to introduce myself to you all. My name is Joshua Lloyd-Jones. I run the marketing at Growth and Wealth Management, and I'll be your host this morning. We've got our four panelist speakers. We have Adrian Dante, John Thompson, and Paul Mallatratt from Opus Business Advisory Group to discuss the business challenges, turnaround possibilities, and managing personal implications. We also have Matthew Bourn from Growth and Wealth Management, who will discuss the types of protection available to business owners to help protect their business during challenging times, as well as highlight options to protect business wealth. We're open to all questions from our audience today, so I encourage you to please submit any questions you have to our speakers through the Q&A function. You can do this by entering them in the Q&A box on the GoToWebinar menu, and we'll answer them during the session. We will also be recording this morning's webinar, and this will be sent to you afterwards. Before we start, I'd just like to point out that Growth and Wealth Management Limited is authorised and regulated by the Financial Conduct Authority. What will be discussed during the webinar is strictly general information and guidance and is not intended to constitute investment, tax, or legal advice. Tax is down to personal circumstance and may be subject to change. So without further ado, I'm going to hand over to Adrian to begin with identifying signs of business challenges that risk insolvency if not addressed. Over to you, Adrian.
Thank you, Joshua. Good morning, everybody. My name is Adrian Dante at Opus Restructuring. I'm an insolvency practitioner and partner in the Mason office, and I head up the Kent and South East region. Next slide, please, Joshua. So I'm just going to spend a few minutes with you just to set the landscape for further presentations regarding the warning signs of business challenges and the early risk to insolvency. Quite a few of these will be quite familiar to people watching today, but I don't think it'll do any harm to actually to go through them and to remind ourselves the difficulties that companies and businesses do face. So first of all, we've got the company consistently lacks sufficient cash flow. The company is functioning at the limits of their overdraft. There's pressure from creditors. The business cannot pay its employees, and directors and business owners spending most of their time firefighting and preventing problems from escalating rather than focusing on the day-to-day activities of their businesses. County court judgments having been received or threatening letters, which leads to fending off of bailiffs and other enforcement action, we come across quite often directors and business owners that have little day-to-day knowledge of their accounts or indeed their cash flow reserves. And something that's quite familiar with everybody that with HMRC at the moment is the time to pay arrangements, although I understand it is that they are being quite strict and wanting to limit these to 12 months. Next slide, please. So the chance of survival and addressing those warning signs. So it's important to know if the business is in trouble. Directors who continue to trade while insolvent risk fines, being made personally liable for the debts of the company, and face potential director disqualification as a result. One aspect of insolvency that surprises so many companies is just how quickly things can sneak up on them. And you'll be aware that experiencing some of the problems paying your debts, but there is a definite line between being in debt and being insolvent. This is a position that, as a company director, you must keep a careful eye on. As soon as the company becomes insolvent, you must act to maximise the creditor's interests. Next slide, please. Thank you. So we apply an insolvency test. It's not. It can take weeks, or months, or even years for a fortune business to become insolvent. And the two basic methods of assessing whether the company is insolvent are as follows. So we've got the simple balance sheet test, i.e., where the company's liabilities are greater than the assets. Slide. And the cash flow test, which effectively is not being able to pay debts as and when they fall due. And you know, and as it says there, do you owe more money at any given time that you can pay? And that kind of balance sheet calculation should include contingent as well as prospective liabilities. So if you received a statutory demand or county court judgment, you should know that these are precedents creditors could use to follow up with a wind-up petition and a final payment demand, after which your company could be forcibly be liquidated. Any legal action may be taken as a strong warning signal. So additional symptoms to account for, already mentioned but worth reiterating, is that the threat of litigation is a huge indicator that insolvency could be on the horizon. If you receive a CCJ, stat demand or wind-up petition, this means you have creditors who are extremely anxious to get what is owed to them and are now using the legal system to do so. And of course, the legal system is designed to escalate the situation. And of course, we are emerging from this pandemic, and this will become more prevalent over the next few months. Thank you for listening, and I'll take questions either in the chat box or further into the webinar. Thank you.
Okay, we'll now hand over to John Thompson to discuss how to turn these issues around and protect your business assets.
Thank you, Joshua. Good morning, everybody. My name is John Thompson, and I head up Opus Business Advisory and Turnaround. I'm going to talk today about how we can turn around these issues that Adrian ran through there that potentially threaten the future of previously profitable companies, and how business owners can protect the value that they've built over previous years. Next slide, please. Before we get into some of the proven methodologies we've effectively used over many years, I just want to talk a little more about the broad issue of company turnaround. Firstly, it's not prescriptive. It's not a tick box exercise as much as many practitioners would like to put forward. As we all know, no two businesses are the same. Each has its own unique way of working and ways of interacting with all stakeholders, both internally and externally. And all of this, of course, needs to be carefully taken into consideration when undertaking a company turnaround. And just talking about company turnaround stroke cash flow, often clients come to us with help for a cash flow issue. And very often they'll be saying, well, if only I had another 200,000 or 100,000 or 50,000, I could get through this. Of course, these cash flow issues are often the result of structural or trading issues, and if they are not addressed in a turnaround strategy, those issues are going to reoccur and the same problems are going to come back. The good news is there's invariably a better route forward. The keys to this are creating a plan, of course. Getting the team on side is absolutely critical, and then combine that with a laser-like focus from the management team to implement the plan and be ready to make changes when needed. Both preserving and creating new value should be the aim, not just a sticking plaster to deal with the immediate issues. We've created a structured approach that seeks to achieve both of these aims, and this broad platform can of course be adjusted for individual situations as appropriate. Next slide, please. Here is the platform, and the four pillars of this platform are stabilization, of course, initially, consolidation, then moving on to creation of a strategic growth plan, and then moving on to implementation and review. I'm going to give you a quick whistle-stop tour through this broad approach, which of course can be made bespoke for individual situations. So I'm just going to run through this quickly. Stage one, with the stabilization phase, this is when there's some stress or distress around. We need to get under the bonnet, address the immediate issues, understand the background in detail, and identify and address the immediate issues. We'd quickly establish a turnaround plan, low-hanging fruit, which will seek to deal with the immediate issues, and then we would implement that. The second stage of the stabilization phase is to control the cash flow, of course, and we'd seek to immediately stem any hemorrhaging of cash, and then confirm a realistic income and expenditure for the next 3 months, 13-week cash flow, and produce the forecast. We'd establish short-term working capital requirements, and of course we'd seek to manage creditor positions, and of course again adjust the cost base where needed. Once that's been achieved, we would then move on to the consolidation phase, and initially we'd seek to manage the performance, really deep dive, deep focus on all business functions. We'd seek to measure all critical performance metrics and immediately address any shortfalls that are falling short of what we're looking at. And then we'd be seeking to give feedback to the relevant people to address these things. Again, within the consolidation phase, we'd be seeking to conserve cash. We'd manage costs, we'd manage margins. We'd focus on credit control. We'd seek to agree payment plans with creditors where possible. And again, where possible, seek to turn non-essential assets or stock, indeed, into cash to boost the cash reserves. We then seek to move on to the strategic growth plan phase. And the first part is to conduct a detailed analysis of the current market and review the existing strategy. Particularly in present times, as we've experienced over the last 18 months, it's incredibly important to address the backdrop against which any business operates. Firstly, then its market, and then the business itself. All of those things need to be addressed and looked at and see how they blend together. We'd seek to establish how the business model could be adapted to better serve existing customers and maximize potential opportunities, and seek to create new value for all stakeholders. We'd then move on and create a stepped plan, document in detail the new growth strategy. We'd communicate the proposed changes to the team to secure everyone's buy-in to the plan to ensure a successful outcome. And the final key area is the implementation, of course. Implementing the plan would be done under we would probably develop a bespoke performance measurement and management system, which we do in most cases. We use a hybrid of the balanced scorecard methodology. And this helps make sure everyone understands the key role they play in achieving the overall aims and the plan, and it ensures complete coordination of all the business functions, which is key in ensuring peak performance. We'd then move on and we'd introduce a continuous review process, which involves the senior team in regular reviews and create a feedback loop. And we'd make changes, we'd seek to make changes where needed and where appropriate. Sorry, that's a bit of a whistle-stop tour through that approach, but I'll happily take any questions at the end. If we could have the next slide, please, Joshua. Finally, I just want to move on to maximisation of business assets. We're seeing more and more situations where owner-managers are seeking support and direction. They've built their businesses, very often they've built the businesses from the ground up, and at this time, everything revolves around them, and it's relentless. In most cases, they see the value in their organisations as a major part of their future security and indeed pension. Many will have had a torrid last 18 months and seen a reduction in this value. In these situations, and as part of the turnaround plan we've just been discussing, we're encouraging these owner managers to think more about succession planning with the aim, possibly over a 12, 24-month period, where they can start to take more of a chairman type role, in inverted commas, where they can start to step back from the front line and less revolves around them. They're not involved in every decision. And of course, this will have a positive effect on the business in a number of ways, enabling the owner manager to enjoy a better work-life balance, one, enable better decision making because they're not tied up in the front line every moment of every day. And of course, this increases the value of the business as it doesn't all revolve around them. If the owner manager so wishes, this is then the first stage in preparing the business either for an MBO, management buyout, or indeed a trade sale. If the MBO route is attractive, this can be achieved in many ways. Share options, employee ownership trusts are being used more and more now, and can be completed over an agreed period of time that works for the owner and indeed the buyers. The route can be very attractive to the owner manager, as he or she may choose to sell, say, 50% of the business to management, which could produce either a lump sum immediately or more likely some substantial monthly payments over an agreed period of time. In addition, the seller could keep their position as chairman and continue to receive a salary for this, which could potentially be part-time, but they would continue to be involved and receive their salary. And then as a final bonus, the new team, the MBO team, may be able to take the organisation onto the next level. It might then complete a further trade sale in a period of time, say, I don't know, 3 to 5 years, when the owner manager, of course, would receive another payout for the remaining 50% of their shareholding. So very much from turnaround to successful trade sale, and as I said early on, preserving and creating value is the aim. Thank you for listening, and I'm of course happy to take any questions at the end of the presentations. I'm now going to hand you over to my colleague Paul Mallatratt.
Good morning, everybody. My name is Paul Mallatratt. I'm a licensed insolvency practitioner based in Nottingham, and I head up the personal insolvency team here at Opus. I'm going to talk to you today about personal guarantees. It's becoming quite a hot topic for us at Opus, particularly with regards to the bounce back loan schemes and various other scarring effects on the wider economy. Next slide, please. So the first question is, how do personal guarantees actually arise? So very often what you'll find is that where a company's got no credit history, it's been recently incorporated, for instance, or where there's a particular supplier that's got a policy that requires a personal guarantee, and also from the company's point of view, where there's a need for credit facilities in low margin businesses such as construction, where cash flows are delayed or tight, creates that need for credit, but very often the personal guarantee has to follow along with the company's actual account. Next slide, please. Okay, so it's really important that you check any contract that you sign on behalf of the company. I can't stress how important that is. What often happens is that the personal guarantee clauses are often kept within the small print of those contracts. You need to understand what the actual liability is that you're signing up to, whether it's a fixed sum or if it's completely unlimited. So it might be that the limit of the liability includes legal and collection costs going forwards. So as I say, read the small print very carefully and make sure you know exactly what you're signing. In addition, if you're involved in multiple companies or multiple directors, be aware who has got the personal guarantee and who also is actually guaranteeing what the company owes. So do you know which directors, for instance, are responsible for agreeing credit limits and then potentially increasing the personal guarantee liability? It's very important that you understand that, simply because if one director's got the guarantee, but the other director is actually putting up the credit limit each time, the company then goes into an insolvent position, the director with the guarantee is on the hook for the company's debts if they can't be repaid by the company. And also, if you ever leave a company or resign as a director, don't forget that you may still remain as a guarantor for the company's liabilities. Make sure you get yourself released from any guarantees if you do depart. Next slide, please. So what are the triggers for personal guarantees to be called upon? Very simply, if the company defaults on its debts in any way, then what will happen is that will trigger likely to be a demand from the supplier to actually repay the sum due under the guarantee. Also, if there's any insolvency procedure by the company, such as it going into liquidation, that will automatically trigger personal guarantee and a demand letter will follow. Next slide, please. So what do these demands mean and what can we actually do about them? So the demand is the start of the legal collection process. You'll find you'll get a formal letter either from a solicitor or the collection team at the supplier. And this allows the creditor to then begin the actual legal process for recovery of the debt. First thing to do is, if the demand letter lands on your doormat, is to get independent advice. So the first thing you want to ensure is the PG actually valid against you, and has the proper process being followed by the creditor? If it hasn't, then there's a risk that the PG may not be valid and you can escape from that liability. However, never ignore the demand. The earlier you engage with the creditor, the less ultimate cost will be, the more likely you'll get an acceptable outcome to both yourself and the supplier. Creditors will always give you time to consider your options, so talk to them. It's in their interest to do so. Tell them you're seeking independent advice and you'll come back to them with any proposals. And that will give you time to take that advice from professionals such as a lawyer, an IP, or other persons who specialise in dealing with directors' guarantees. Next slide, please. So there are potential adverse consequences to you personally from the demand letter process being started. If you don't deal with the demand letter promptly, the creditor can start court proceedings and get a county court judgment against you. And that would have a massive impact, both in terms of your credit file, your ability to obtain credit in the future, potentially even remortgage. So it's important you don't let it get to the legal stage where a CCJ is entered against you. Following on from that, the creditor can commence legal action via the courts to potentially make you bankrupt. That starts with a statutory demand, and if that's not dealt with within a 3-week process, then a bankruptcy petition can follow. That's so long as the debt is at least £5,000. That's a statutory limit. But anything over that, the creditor can pursue potentially you for a liquidated claim through the bankruptcy route. One other option that they might have is they can try and get a charging over order over your family home, your share of the equity, and obviously that's got quite a big impact if you want to remortgage for any reason. Next slide, please. So what are the options and solutions available? Well, there are a number to avoid the worst possible outcomes. As I said earlier, get early professional advice. The sooner the better to maximise the options available to you. Creditors will almost always negotiate and prefer to do a commercial deal, get something back before other creditors come along, for instance. And don't forget, if you've instructed a professional advisor to help you, they can help with the negotiations and very probably get a better deal for you with the creditor. If you've got a few creditors, then you may be able to enter into an informal payment agreement with them. If you've got more than a handful, however, the chances are that you're potentially insolvent on a personal level, and you'll need some sort of formal agreement with your creditors, such as an individual voluntary arrangement. The advantage to the formal IVA is that it actually binds you and your creditors to the amount you say you can pay and they agree you will pay. And once that's repaid, it avoids the stigma of bankruptcy and those adverse consequences. I hope that gives you a brief whistle-stop tour and insight into how guarantees can affect you. I'll be happy to take any questions now. If anyone wants to contact me directly outside of this forum, I'm happy to sort of speak to them on an individual basis to discuss any particular needs they might have. Thank you very much for listening, and I'll now hand over to Matthew.
Good morning, and thank you for joining this webinar. I'm Matthew Bourn, and I am a Chartered Financial Advisor for Grosvenor Wealth Management. And today we're going to be talking about protecting personal and business wealth and the importance of doing so. So starting with key person protection, essentially a couple of key questions. How would the business cope without key people in your business? How can you smooth over any transition in the event that happens? How does a key person protect plan work? And is there any tax relief on premiums? Essentially, if you or a key member of your staff became critically ill or passed away unexpectedly, you'll think to yourself, how would the business cope? Taking out key person protection could help smooth over any transition, as the payout can be used to cover the costs of recruiting a replacement or even to mitigate any loss in profits. Whether your business is a limited company, a partnership, or you are a sole trader, a key person protection plan will provide cover for you or any partner or employee who is valuable to your business. For limited companies, any payments go directly to the company, and if you're in a partnership or a sole trader, then the policy is held under trust and the trustees own the policy. In some circumstances, there may be tax relief available on premiums, and in all cases, it's a good idea to talk to an independent financial advisor about your particular circumstances before you make any decisions. Another type of protection is shareholder protection. If a major shareholder of a business becomes critically ill or was to die, it can sometimes be difficult for the remaining shareholders to find the immediate funds that they need to buy back the person's shares. A shareholder protection policy provides life and/or critical illness cover held in trust, and so any payout will give them the means by which to buy the shares back, with the option of keeping them or selling the share of the business while enabling the company to continue trading effectively. Because the policy is held under trust and owned by the trustees, the payments won't be viewed as part of the person's estate for inheritance tax purposes. However, in some circumstances, there may be capital gains tax implications for the beneficiaries if the value of the shares rises substantially between death and any sales. And if you're concerned about tax implications, we can give you advice based on your own particular situation. Another type of protection is business loan protection. Extremely relevant at the moment with the COVID recovery loans and the mounting debts throughout businesses. It is research shows that actually over 50% of businesses now have debts in an average of £176,000. So there's a lot of money there that would need to be repaid if anything was to go wrong. So you can get a life policy that covers the business to pay off any outstanding loans if a major shareholder, partner, or even an employee becomes critically ill or dies. As with key person protection, if your business is a limited company, the company owns the policy, while if you're in a partnership or a sole trader, the policy is then held in trust. Essentially, the purpose of this cover is to pay off any specific loans to the business if the person covered dies or becomes ill and is unable to pay. There are unlikely to be any tax implications, although some charges may apply on some trusts. And again, it's best to get advice from an independent financial advisor on the best policy for your business. You can also get a relevant life plan. Now, a relevant life plan is a form of life insurance, but it's set up by a business to provide cover for the life of the employee, and with any payments going to the employee's family or dependents. The policy will be held in trust, and the beneficiaries can include the employee for critical illness cover, their spouse or civil partner, and any of their children or grandchildren, including stepchildren. This can be a tax-efficient approach for both employers and employees, and there are no income tax or national insurance liabilities on the payments, and usually premiums can be treated as a business expense and claimed against income or corporation tax. This will depend on whether the policy meets certain tax rules, so again, it's really important that you speak through this with an independent financial advisor for guidance on that. So moving on, are there any questions from anyone today?
Thank you very much for that, Matt, and thank you very much to Adrian, John, and Paul. So as Matt just said, is there any questions from our audience today? We're open to all questions. So if you don't want to raise them publicly, you can put them in the chat or you can put them in our Q&A box. These can be answered on the webinar or they can be answered offline. We've got our first question. Have you seen an increase in businesses needing support over the past 2 years?
Okay, Joshua, shall I take that one?
Please.
Yeah. Well, certainly there has been, from my experience, there's been an increase, a gradual increase over this recent period in particular, as the various government initiatives have slowed and more people are coming to us seeking for some help and direction. And in particular, it seems to be as I mentioned in my piece, the owner manager who has had in mind some form of exit plan at some stage that hadn't necessarily been formulated, but they've been put aside as the pandemic has taken a toll on the businesses. So they need both assistance in turning the business around and then getting back into a situation where they can create some value in some way, as we discussed in the piece, for future income as they move forward and potentially sell the business. So yes, certainly an increase in that. More and more people are coming forward seeking that sort of support.
Thank you very much, John, for answering that. Are there any other questions from the audience today? Okay, if there are no more questions, then we will wrap up the webinar there. Thank you very much for attending this morning. And as I mentioned, this is the first 2 webinars, so we will have the second one going live on Wednesday, the 13th of October. So if you'd like to register for that, please get in touch. You can register through either Grosvenor, we can go through to Opus. We will be releasing details around this particular part 2 webinar in the next week or so. We've actually just had one last minute question come through actually. Are banks and ABLs providing supports as COVID impacted companies unfreeze? Are their turnaround phases not sequential but overlap and run concurrently? Sorry, does anyone want to take that one?
Sorry, I was muted.
Okay, do you want me just to read the question again? So it's
yes. Yeah, apologies, I was muted.
No, that's okay. Are banks and ABLs providing WC support as COVID impacted companies unfreeze? Are the turnaround phases not sequential but overlap and run concurrently?
Yeah, good question. Yeah, good question. So in terms of banks and ABLs, my experience at the moment is, particularly the ABLs, have not been adversely affected during the pandemic period, due to the large level of government support available, and in fact, I think most would say that their funds in use has gone down rather than up, which was the expectation at the beginning. Banks mixed. As the guy spoke about earlier on, the various loans that have been made available, the bounce back loans, the collection of those over a period of time will be an issue. In terms of ongoing support, I think my feeling is the banks won't be, at the moment, are not coming forward because it's not necessary right at this moment. I think moving forward, there probably will be more necessity, because that I feel that there's already a period of zombification, and lots of zombie companies that are out there that have managed to survive on the basis of having had a poor 2019, which wasn't great, but then being able to actually enjoy probably a better cash flow with government support than they did otherwise. But of course, now those issues are coming back to hit them as the level of government support and the creditor actions slowly being enabled. So I think we have to watch this space in that respect. Good question with regard to overlap and concurrent methodologies within the turnaround phase, and absolutely, yes, absolutely overlap, and can be a bit of a Gantt chart thing going on where there are simultaneous actions taking place, and there will be overlap. For instance, as I was talking about there, where we're looking at a short-term turnaround strategy, but also then going to be looking at a longer-term growth strategy, there will be some components of both that will indeed lead to overlap and run concurrently. So yes, I absolutely feel, and as I said right at the very beginning, in my experience of this of company turnaround, both for myself and for clients, it's not prescriptive. It's every situation is different, and of course you do have to adjust the route forward in every situation. So I hope that answers the question in some way. Thank you.
Thank you very much, John. Okay, so if there's no more questions, then we will wrap up the webinar there. Thank you very much to our speakers today from both Grosvenor Wealth Management and Opus. And we look forward to seeing you again on Wednesday, the 13th of October for the second part of the webinar series. Thank you very much and have a good morning.